All right, what's up, everybody? It's Ken here, and today I want to walk you through probably the number one secret that you'll need to learn if you're going to master real estate investing. If you want to build a $100 million portfolio, then this is absolutely the biggest secret that you're ever going to have to deal with. It is so freaking important that you understand this stuff, and so I want to take the time to really walk you through it and help you to understand.
Hey, my name's Ken, and I'm a real estate investor. I want to welcome you to the No Money Real Estate Podcast. On this show, I'm going to interview elite level real estate investors from all over North America. And I'm going to help you to see one thing that all successful real estate investors have in common. They built their portfolios without using a dime of their own money. I've got a portfolio of $300 million in real estate. That includes resorts, apartment buildings, commercial buildings, and I built the entire portfolio without using a dime of my own money. Real estate is a business that anybody can get into, but the strategies that those tight real estate investors use to build massive portfolios have been kept secret for decades. Now, because of this show, I'm going to reveal them to you. So let's get started.
Okay, I want to get right into this right away, but I want to talk to everybody first, just for a second, for those that are just getting to know me and have found me in my real estate teachings online here. If you're not already subscribed to our YouTube channel, I'm going to put the link in the comments. Go ahead and make sure you get subscribed to that channel now, because I share everything I know about real estate investing on that channel. And this is going to be a little bit of a longer session today, but I'm going to pull up the chalkboard and really help people to understand the secret that most major real estate investors know, and this is called debt stacking. If you can learn anything and master anything, it's running the numbers using debt to acquire your deals and do your deals. And if you know how to stack the debt in a certain way to get an overall lower interest rate, you're going to master this whole skill. And I want you to really get it. So I'm going to draw it out for you today. Nothing beats coffee in the morning. Anyway, so I'm Ken Dunn. I have a $100 million real estate portfolio. I've been investing in real estate for over 30 years. I've only been publicly talking about it for about 5 years now. But anyway, let me talk to you about debt stacking and what it's all about. I'd say the first thing that I want to tell you is I realized the importance of this technique just from having hundreds of conversations with real estate investors across Canada. One of the biggest things that I found that people were struggling with when they were trying to build real estate portfolios was getting the money to do it. And I had countless conversations with investors who got into projects and they didn't know how to acquire the funds to close on a deal, and they would start panicking at the last minute and spamming in Facebook groups and really struggling to figure out how to do this stuff. And it was painful when it happened. And that's kind of where I developed my desire to help people with this stuff. And I think the easiest way for me to show you get exactly how to do this would be to pull up my chalkboard and draw you through a couple examples. So the very first thing that I want to talk to you about is, I'm going to use the simplest example. I'm going to use a house flip. And for those that don't know what a house flip is, it's simply where you buy an old dilapidated property, and there are literally thousands of old houses across Canada that are just sitting there empty, waiting for somebody to rehab them. So you buy an old dilapidated property, and you can typically buy those properties for 40 cents on the dollar, really cheap. Then you figure out how much it's going to cost you to renovate the property. You borrow all the money to acquire the property. You borrow all the money to renovate the property. But before you've purchased it, you actually get an appraisal done that will tell you what it's going to be worth when it's finished. And you only do these deals if you can see $200,000 in a profit between your numbers and the appraisal. So it takes a lot of the risk out of it. Now, there's still risks involved in all of this stuff, which I'll talk about in a second, but I want to explain to you how you get the money for real estate investing. It's really, really simple once you understand it. So let me just pull up my chalkboard here, and I'm going to walk you through this and really help you to understand what this is all about. So let's just dial into this right now. So the first thing I want to talk to you about is our example. Let me just write that on the screen. You guys are going to have to forgive me for my horrible penmanship. But let's just say you're doing a house flip, and I'm just going to take an average price in Canada. Let's say you buy a property for $300,000. Now, this property is in horrible shape. But you went out and looked at it with a real estate agent, and you got the agent to give you comparables. So there's a couple things I should go over at the same time as this. Whenever you look at a property, I always use real estate agents, even if I find the deal myself. And the biggest reason is the comps. Real estate agents across Canada have access to every listing across Canada. They have access to all the places that have sold. They have access to everything that's happened in the market. And so I like to use agents, if for nothing else, for the comps. What I mean by that is this. There's a couple core rules about real estate investing. Number one, first rule, never buy a property overvalued. So I will only buy a property if I can confirm that that's a good price or that I'm getting it undervalued. So I'll get a real estate agent to give me 3 comps. When I first see the property, I'll go look at it. I can typically tell because I've looked at so many properties that it's going to work. Then I'll go to the agent and I'll say, okay, I want 3 comparables. Go find me 3 houses that have sold in the last 90 days that are like the house we're buying. Same square footage, same amount of rooms, same state of disrepair, same shabby backyards or whatever the case is. And they'll go out and they'll find me 3 properties that have sold. We'll take those values, add them up, divide by 3, and that will give me my average comp, my average comparable. And I want that value, that agent to be more than that, ideally, or at least the same price as that. If that agent comes back and says this property isn't worth this price, I'm going to try and negotiate that price down or walk away from the deal. So if the agent tells me that the comps work, the next thing I'm going to do is I'm going to do the math quickly, and I'm going to explain what I mean by this. I'm going to look at the property and I'm going to say, okay, how much do I have to put in this place to renovate it? And then what's it going to be worth? And I always figure out my renovation numbers first. So let's say in this example, I just write out as I'm going through the place what it needs. So it needs new engineered hardwood floors. It needs a new kitchen. It needs a new bathroom. It needs a new panel and electrical upgrades. These are just some of the things you're more typically going to see when you're looking at a property like this. It needs to be repainted. And the basement is unfinished. This is one of my major secrets I look for when I'm doing any type of house flip. And if the basement's unfinished, I'm going to try and get a bedroom in the basement if there's a means of egress, meaning a window that's big enough that we can have a bedroom, and another bathroom. But I'll just say basement renos. I always put an EV charger in every property that I flip because it's that time of the world, and then landscaping outside. And then once I figure this out, I'll go back and assign my prices. So new flooring, let's just say 20 grand. New kitchen's going to be 10 grand. Actually, we need to have a 2-piece bathroom installed too. A lot of these old houses won't have a little powder room, which makes all the difference in the world. New bathroom, 10 grand. New electrical with a panel is 30 grand. Painting for the place, let's say we can get that for 7 grand. New basement with everything I told you averages me about 25,000. EV charger, $1,500. I always put $10,000 in the budget for landscaping, and a 2-piece bathroom will be about 5 grand. Now, when you start doing real estate investing, you're going to this is going to make you uncomfortable trying to figure this stuff out, but this will come over time. So we got 20,000 plus 10,000 plus 10,000 plus 30,000 for the electrical plus 7,000 plus 25,000 plus 10,000 plus 5,000. So that's $117,000 that it's going to cost me to renovate this place. That number is incredibly important. So I'm just going to write that up here. Now, the other thing I always do, just to be safe, is I always put a 10% contingency fund. So 10% of that is $11,700 that I'm going to add to the renovations budget. So now I need $128,700 or $130K just to be safe. So now we're going to say renos are $130K. That's a really great safe number. So $130K. Okay, so check this out. If I haven't bought the place yet. I do this all before I buy the place. So what I'm doing by looking at this is I'm now going to take this, add the 130K to the 300K, which is now 430. Now, the next thing that I want to add to my budget is what we call an interest reserve. Now, what you're going to see in a second is the power of debt stacking and how this works. But just follow along with me here. So if I have $430,000 that I'm putting into this, I'm going to use all private money to do this. So I'm going to take 15%. 130, so let's say 430,000 times 15% equals. So that's $64,000 that I'm going to pay in interest during the course of this project. If it goes a full year, which it never does. But when I'm doing these numbers up front, I want to make sure that I'm always adding a buffer in so that I know that I don't ever get myself in any trouble. But that's the number that I have to get to. Now, if this is going to work as a flip, I want to factor in $200,000 in profit. Because when I sell the place, the real estate agents are going to get a piece, and there's going to be other expenses. There might be staging expenses and all the rest of it. So now what that means is I need to sell this place for $694,000. And that's taking into account that I keep my budget on track. And if I do, the real estate agent 694,500 times 5% equals, the real estate agent's going to get $34,725 of that amount minus 34,750 equals 659,750. And now if I subtract the 494,500 that I'm my all-in price, that leaves me with $165,250 in profit. So that's the math. I mean, that's how it works in theory, but there's a couple more things that you want to do before you put your offer in. Or what I would do now is if these numbers work. So this number here, once I know what this is what it costs me plus, this is my all-in cost, right? Or sorry, my all-in cost is here. This is the number plus 200K. So that number, I'm going to go back to the agent again, and I'm going to ask for comps again. And I'm going to tell the agent what I'm going to do to the place. I'm going to say, I need to know what I can sell this property for when it's done. So I get her to go get me 3 comparables in the same neighborhood that are the same standard as all the upgrades that I'm doing. And she'll come back to me and she'll say, okay, we had one that sold for $760, one that sold for $758, and one that sold for $730. So if I add those up, 760,123 plus 758,123 plus 730,123 equals, divided by 3 equals 749,333. Now, let me explain something that just happened. These are the comps. So this is the average comp value. This is a good indication of what I'm going to sell the place for. And you can see what I need to sell the place for is $694. And these comps came in at $749. So when I see those numbers, I'm going to put an offer in. So I'll put an offer in to buy the property now. I normally put a $20,000 down payment, and I get that down payment from my American Express Platinum card. So I do these deals with not a dime of my own money in the deals. Now, I normally only put 2 conditions in my appraisals. Whenever I buy a property for a flip or something like this, I want 5 visits before closing. So that allows me the time to go back with my contractors and make sure I can get everything taken out. And the last thing is I want to order an appraisal. Ordering an appraisal is a very standard condition in any real estate deal. The good thing about ordering an appraisal is that you now can get an appraiser in there who is an accredited person who has to give you real values. And when I get an appraiser to come into a property, I do something that I've never heard other real estate investors talking about or even real estate coaches talking about. It's called a double-ended appraisal. I'll ask the appraiser to do 2 appraisals for me when they come. First is an as-is value. So I'll ask the appraiser to figure out what is this property really worth right now. And the second appraisal is called an ARV value, after repair value. So I want the appraiser to validate this number and this number, or this number here. So I've seen this happen so many times where the appraiser comes back and says, right now it's worth $325,000. So I can check the mark on the as-is value. And now because I've been doing this for so long, I'm pretty good with the numbers. They come back with the ARV value and say it's going to be worth $70.25. The great thing about appraisers is that if you can buy this property, close, renovate it, and sell it within 6 months, they're normally bang on with both of these numbers. Now, let's say it didn't go like that. Let's say I actually looked at a property in town where I live here that I was putting in an offer at 1.15. The appraiser came back and said it was only worth $900,000. I don't question the appraiser because I found an appraiser that I trust completely. His name is Eduardo Reyes over at Community Appraisals. If you're in Ontario, check them out. Shameless plug. I'll put their link in the chat, and he knows what he's doing. So I walked away from the deal because of that appraisal. It saved me money. But most often, his appraisals come back where we want them to be, and then we'll waive conditions and move forward on the deal. Now, finally, I'm going to talk to you about debt stacking. Debt stacking is the most important part of real estate investing. I'm not going to talk to you in this video about how you actually get investors to give you the money. But I'm going to talk about how to structure this the right way. So in order to do this deal, we need $300,000 to buy this. We need $130,000 to renovate. There's $64,000 to pay our interest payments. I don't pay for anything when I'm doing these deals, and neither should you. It's very acceptable to have what's called an interest reserve to cover your payments while you're flipping the property and selling it. Now, let's talk about the secret art of debt stacking. That's what I teased you with to get you to watch this video. Now let me deliver the goods to you. Debt stacking is where you take this money you need to borrow and you break it into separate mortgages so that you can offer less risk to the people who lend the biggest part of the money, which means they'll give you a lower interest rate and you can get yourself an overall effective lower interest rate. So if I'm buying a place for $300,000, I can normally get a first mortgage for 75% of that. So my first mortgage would be $225,000. And it's all private money, so it's expensive money, but it all fits in the budget. And it all fits in the numbers that we just did. So that's why we do it. Normally, I can get that first mortgage. I just did one at $225,000 at 9%. So 225,123 times 9% equals. So that's $20,250. And I'll divide that by 12 because you make those interest payments every month as you're going through the project. Now, if I'm buying the place for $300,000, I've got a first mortgage for $225,000, then my second mortgage is $75,000. And I normally can get that mortgage. I just did one at 11%. So $75,000 times 11% equals $82,50. Divide that by 12 equals $687.50. Now that third mortgage is $194,000. Now here's what's interesting. The appraisal came back and said the property is worth $325,123 as is. So it's not hard to get somebody to give me the first mortgage because it's under $325,000. What that means is if something went wrong with this project and they had to sell it quick, they would be selling it at that appraised value. And that first mortgage, the person who lent this $225,000 would get all their money back because they're in first place. They get their money back first. And that's why they're willing to give you that 9% because the risk is the lowest because even if something went dreadfully wrong, there's a really good chance they're going to get all their money back. Now, as you go down the debt stack, the interest rate gets higher. Why? Because the risk gets higher. So this $75,000, even though 225 and 75 is only $300K, it's still below the value, but it's a lot closer. So if you had to sell it quick, you'd probably sell it at a fire sale. You might not get all that money back. That's why the interest rate goes from 9% to 11%, because this lender realizes that there's still a really good chance they're going to get their money back. All right, let's talk about this third mortgage, which, as you know now, is a combination of the money that we need to renovate the property and the money we need for the interest reserve. Now, it's the highest, it's the most risk, because when they're lending that money, the property is only worth $325,000 and they're lending over the appraised value. Now, why would they do that? It's because of that ARV appraisal. So remember, we got an ARV appraisal done that said the place is going to be worth $725,000. What you want to do over time, if you watch the other videos on my YouTube channel or go through the rest of the videos in this course, you're going to learn the art of building rapport with lenders, finding your lenders, building trust with the lenders, and letting them lend money to you. And so when you do that, they're going to be willing to trust you more because they've seen you do successful projects. And that's the beauty of how this works. But because they're going in third place and they're lending against the ARV, the interest rate's going to be higher. So that'll be 15%. So 193 times 15% equals, so that's 29,100. Divide that by 12 equals 2425. Now check this out. If I add up all the interest charges, 20250 plus 8250 for the second plus 2910 for the third, the total is 57,600. But I took 64,000 from my interest reserve, so I'm covered. Now, what's beautiful about this is most often I do these flips in 6 months, which means I'm only paying half of that. So I'm only going to pay about 35K, which means there's an extra 30 grand in my interest reserve, which drives up my profit even higher. So I'll do this flip in 4 to 6 months, then I'll sell it for 700. Everybody gets paid. Now let's talk about why I call this debt stacking. What I want you to realize is this. The total amount I needed for this project was $494,000. If I were to go out and borrow $494 from one person, they would charge me 15%. Times 15% equals, let me see, 494,123 times 15% equals 74,100. Because I used debt stacking and I gave a lower amount of risk to the early ones and got lower interest rates, my total interest charge is only 57,000. So it's about 18K less that I'm saving because I stacked the debt the way I did. And that's debt stacking. So let me go back over here for a second. I think I still have, yeah, okay. So you guys remember, if you watch other videos on this channel, you know the 4 steps I believe are the master 4 steps for mastering real estate investing. And here they are. Number 1, buy your properties under value. Oh, darn, that's horrible. Buy under value. Number 2, use OPM. Number 3, renovate. And number 4 is exit. Let's talk about that for a second as we wrap up here. In this example, I bought a house for 300 grand. I put 130,000 in renovations to it. I had a total of 494,000 in total expenses, and then I sold it for 720. So I walked away with about $180,000. The exit is when I sell the property. If I was doing a buy and hold strategy, like when I'm buying my resorts and building the resorts, or anything else I'm doing where I keep the properties, I use the same model. When I first buy a resort, I'll use a debt stack to get 100% of the money I need to acquire the property. Then I'll renovate the property, I'll increase the value, and then my exit is refinancing the property with a lender and paying all these guys back. So it doesn't matter what type of real estate investing you guys are doing, debt stacking is the key. It leads to a lower overall interest rate, and it will help you to do everything you want in real estate investing. Hey, listen, if this instructional video was helpful to you, then do me a favor, give me comments below, subscribe to the channel. If you really loved this video and it made sense to you, share it with other people. There's a lot of people out there getting into real estate investing and making tons of mistakes. There's a lot of people in real estate investing that don't know these techniques. I hope you enjoyed this, and we'll see you again soon.